What's going on, everyone? I hope you're prepared for the major development that just unfolded. Only a few hours ago, the Federal Reserve announced yet another interest rate cut, the third one this year. But this time, things are very different. For the first time in history, the Fed decided to lower rates without having any inflation data to rely on. The October jobs report never came out due to the government shutdown, meaning the central bank is now making decisions in the dark, while simultaneously flooding the system with new money. At the same time, Japan's economy is dangerously close to a breaking point. That's why today we need to break down exactly what just happened, what the Federal Reserve is signaling, how Japan could seriously affect the US economy, and most importantly, how you can position yourself to potentially benefit. Because honestly, this moment could either become the largest transfer of wealth we've ever witnessed, or the point where many people get completely wiped out. Before we jump in, if you enjoy real-time market updates like this, please consider hitting the like button and subscribing if you haven't already. It helps the channel more than you know. And as a thank you, here's a quick clip of Bailey enjoying a treat. Also, a big thanks to the Gemini credit card for sponsoring today's video. More on that shortly. Now, let's talk about something that almost nobody is paying attention to. Yet, it's been quietly shaping markets all year: the Japanese carry trade. Even though the name sounds complicated, the concept is actually very simple. For over 3 decades, Japan has struggled with deflation, an aging population, and weak economic growth. To fight this, the country kept interest rates near zero for years, encouraging borrowing and spending. This worked because inflation in Japan was nearly non-existent. Meanwhile, global interest rates usually stay balanced, until recently, when inflation exploded in the US between 2021 and 2023. The Federal Reserve was forced to raise rates faster than ever before. Suddenly, US bonds were offering much higher returns than almost anywhere else in the world, with virtually no risk. This created a massive opportunity. Investors could borrow Japanese yen at extremely low interest rates, convert it into US dollars, buy US treasuries yielding over 5%, and pocket the difference. Those essentially free money, until it wasn't. Over the past few months, Japan has begun tightening its policy and raising interest rates to stimulate its economy. That cheap money is disappearing. As borrowing costs rise, investors are rushing to unwind their positions. They're selling US dollars, dumping stocks, exiting crypto positions, and sending capital back to Japan to cover rising debt costs. In the short term, this puts serious pressure on global markets. So what does this mean for stocks? Here's where things get interesting. Historically, the Federal Reserve doesn't cut rates unless there's a serious reason. They don't do it to pump markets higher. They do it because they see trouble ahead. This happened in 2001 during the dot-com collapse, in 2008 during the financial crisis, and again in 2020 before the global shutdown. In every case, markets fell not because of rate cuts, but because of the economic damage that forced those cuts in the first place. So, with more cuts expected through 2026, does that mean disaster is guaranteed? Not necessarily. Markets have always recovered, sometimes delivering massive returns, but patience is key. So far, markets have remained surprisingly strong, driven largely by AI growth and consumer spending. Corrections like the ones we're seeing now are completely normal thing. On average, a 10% market pullback occurs roughly every 16 months. Over the last 2 decades, we've seen this happen more than 11 times. Historically, the average decline has been around 15.6% and lasts about 72 days. Now let's talk about Bitcoin. Interestingly, this is the first time gold is performing extremely well, while Bitcoin is positioned for losses. While some claim this proves Bitcoin is broken, history tells a different story. Over the last 15 years, Bitcoin has experienced multiple drops, ranging from 50% to as much as 80%. Year-over-year declines of 30% to 70% are not unusual. What we're seeing now is a perfect storm: excessive leverage, forced liquidations, reduced liquidity, and profit-taking as higher treasury yields become more attractive. With fewer buyers stepping in, prices fall faster. Is this a buying opportunity? Statistically, Bitcoin's median drop has been around 50%, and since 2017, closer to 40%. Code. Interestingly, Bitcoin has never fallen below its estimated production cost, currently around $71,000. That suggests today's prices could represent a strong long-term entry, even if volatility continues. As for my own strategy, I don't try to time the market. I consistently buy and hold for the long term. Even Morgan Stanley has suggested allocating around 4% of a portfolio to Bitcoin, recommending regular quarterly purchases. That's why tools like the Gemini credit card can help investors gain exposure effortlessly by earning crypto rewards on everyday spending. Now shifting to housing, a topic close to home for me since I recently sold a property in Los Angeles. Buyer demand is still strong, but only when homes are priced realistically. Many sellers with ultra-low mortgage rates list homes at inflated prices and wait. When they don't sell, price cuts follow. In fact, the average US listing saw nearly $25,000 in cumulative price reductions in October, the largest on record. While this seems positive for buyers, the market is split between pre-2022 owners who can wait and newer buyers who are more price-sensitive. Median home prices are now down about 7% from peak levels. However, Redfin still expects prices to rise into 2026 due to lower mortgage rates and rising incomes. In short, anything is possible. Finally, let's talk about what the Federal Reserve actually did today. They cut rates by 25 basis points, officially ended quantitative tightening, and reopened the door to liquidity. On top of that, they plan to purchase $40 billion in US Treasuries over the next month to stabilize markets. Their projections suggest only one additional rate cut in 2026, assuming employment remains strong and inflation falls to 2% by 2027. GDP is expected to remain steady. My takeaway: 2025 and 2026 are going to be extremely volatile. The Fed is clearly willing to intervene aggressively if needed. Liquidity is tight, spending is slowing, and AI is reshaping jobs faster than expected. The smartest move is sticking to fundamentals: emergency savings, stable income, consistent investing, and avoiding emotional decisions. What happened today wasn't just another rate cut. It marked a turning point, cutting rates without inflation data, ending tightening, and injecting money into an economy that couldn't even be measured due to a shutdown. This environment creates risk, but also opportunity. Things are changing faster than the data can keep up. This feels like just the beginning. And that's why the next few years are going to reward discipline more than speculation. This isn't the time to chase hype or panic over headlines. It's about understanding cycles, protecting your downside, and staying flexible as conditions change. Markets will continue to swing, narratives will keep shifting, and data will lag behind reality. Those who focus on long-term positioning instead of short-term noise tend to come out ahead. The goal isn't to predict every move, it's to stay prepared no matter which direction things go. Because in uncertain times like these, consistency, patience, and clarity become your biggest advantages. Thanks for watching. Don't forget to like, subscribe, and leave a comment. I'm replying to them right now. Until next time.